Hello, this is Jonathan Mickles with the Strategic Multifamily Investing Podcast, and I have with me Mr. Craig Adams. How's it going, Craig?
I'm good, Jonathan.
Good. Craig is an insurance broker, and we met on a recent panel with Aaron Rice in race and real estate. And he had some very interesting thoughts about insurance. And, maybe some people may not have thought about that. And while, our podcast is mainly focused towards commercial real estate, I recognize that, sometimes we do talk about residential real estate, but there is even a twist here, I think, that could potentially help those that are also investing in commercial real estate. So with that being the case, let's first hear about Craig. Craig, can you tell us a bit more about your background, how you got interested in insurance?
I got it, Jonathan. I'm Craig Adams, State Farm agent since January 1st, 2019. Worked for 4 other companies. Been in the industry for 12 years since '07. So I guess I'm going up on 13 years next year in April. I feel as though I'm very educated and about the industry due to the competitive nature, especially it's price driven, very price driven. So I think I'm very knowledgeable about that because most people normally and typically come to us and the first thing they're concerned about is price.
Yeah. So, I mean, like if I had a client, we'd be looking for, a homeowner's insurance policy. So describe to me, kind of how the experience is with you once I have a referral and I'm saying, look, Craig, this person is looking for homeowners insurance and they seem to be all about price. How do you handle that?
Right up front. Mr. and Mrs. Customer, I know you're, I know you want to know what the price is, which I'm going to give it to them. I get that. And I tell them, Jonathan, I'm telling you, I tell them, I tell my classes. Mm-hmm. Most people come to me, they are familiar and they have experience with the car buying experience. Right. And most of us focus on price, like me. They bring that same experience to the home buying experience, and they're not the same. So what my job is to do to educate them and empower them, whether or not they use me or not, which I would prefer, but if they don't, I get it, is I'm walking them through that policy line by line.
Got it.
Line by line.
So your differentiation point is not on price, but on what's actually in the policy.
Yes, I was trained that way when I first came to State Farm. Okay. And I gotta take it a step further. I hate to plug my company and myself because I just like to talk about insurance.
It's okay. You're more than welcome. This platform.
I do because I don't feel as though I need to knock the competition down. But when I first came there, my mentor Norman Thomas told me, he said, Craig, everybody's gonna come to you with price, and they're not gonna want to talk to you. You got to disarm them. They don't want to talk to me. What's the price? How much is it going to cost? I got a quote over from another company. It was $700. What is it? They don't want to know. And I'm telling them in that conversation, look, not all, but most people, when they get these policies, they don't look at them.
Right.
They don't. Jonathan, when I first got my insurance license, the first thing I did, I looked at my car insurance policy and was like, I never looked at it. I never looked at it.
Okay.
I never looked at it.
Right.
They don't know. So then this next thing they do, if they don't get a claim, but God forbid they get one and they get one, now it's boop, 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 boop. Craig, what is it? And it's like, okay, I'm cool with that because I'm an agent. That's my job.
Right.
However, everyone doesn't have an agent.
Right.
State Farm, we have agents. We have 18,000 agents. Nationwide has agents. I work for Nationwide. You call these other carriers, you don't have it. They're patching you into the claims department and you're making a claim. You're not getting anybody to, well, what's going on? When that call comes in, Jonathan, and that first person, I'm going to tell you how the call goes too, by the way. So I love doing this. People laugh at me. Call goes like this, something like this. Mr. Adams, I've been with y'all 25 years. I'm paying y'all all this money. I got a claim. I need to file a claim. That's how the majority of them go. And the first thing I say is, customer, tell me what happened. Talk to me. Man, I came home and I got 5 shingles in my driveway, man. I don't know what's going on. Okay, calm down. Pump your brakes. Okay, you got some shingles in the driveway, right? Okay. Weather might have been strong winds, knock some shingles down. Get an estimate. You know how much it costs to get that repaired? No. Well, that's what I got you for. I understand that, Mr. Customer.
Right.
That's how these calls go, man. I understand that, Mr. Customer. I'm saying this for a reason, because you may have something that you're covered for, but you may not want to file a claim because if it's lower than your deductible,
Right.
and you can pay it out of pocket, and you're not hit with that loss, and it's not on your report, you may not want that.
Right.
These people are not educated on this type of stuff. I got a good friend on my best. I got a good friend that's with another company right now, dying the company. Can't wait in February. He filed 4 claims. Jonathan, none of those claims are. Well, that's wrong. One of them was like $6,000. I wasn't mad at that one. He had to do what he had to do. The other 3, $1,300, $1,500, and $1,800. He should have never filed them, and he's pissed off at his insurance company because he filed.
Why should he have never filed them? Help me understand that.
Well, I wouldn't say never.
Because his deductible was higher than those.
Bingo. Now you're going deeper in the woods now. Now you're pulling stuff out of me. So yes, you're right. Not only that, and it's more to it. His deductible was $1,000. So if he filed a $1,500 claim, he only got $500 back. So he's like, Craig, I got $500 back to it. But I'm like, stay with me. So now I'm like, well, you're happy because your insurance carrier gave you $500 to assist you. Sorry about that. I got an incoming call. I don't know if you can hear that. But
do you need to
he got $500 back, and you're happy about getting $500 back, but now you got another claim on your report, and that's within a 3-year period. And the insurance company he's with at the time jacked up his rate. Watch when I tell you this, I want to see your face. He's got a townhouse. He just sold the house, by the way. He just moved. He just sold it. That same townhouse, he was paying $3,600 a year for homeowners.
$3,600 a year for, instead of paying.
For a
I don't know.
townhouse.
He may have been in a bad. Yeah, I know, but I'm just like, was he in a very difficult, challenging area?
Upper Marlboro.
Okay. Generally, for everybody else who's listening, because again, this some people may not know the area. What is generally the homeowners insurance in Upper Marlboro?
Put it this way: I live in a townhouse. I'm in this house. I went with a higher deductible when I bought this house. I just switched it literally like 3 weeks ago. I don't even pay $1,000 a year.
Got it. So he was in a really bad way to go by filing those particular claims.
They jacked up his rate for every claim.
Yeah. So you go through the policy with someone, like if I was sending you a referral. Okay?
Yes.
And then after you do that, then what? You give them the number and then that's it, or?
Let's start back to the top. So what I'm doing is I'm starting from the very top. So I'm going with the replacement cost to rebuild the house. I'm letting them know why we're insuring it for the amount we're insuring it. This is very important because I talk about this in my classes, because we'll have, I got to use this example. We'll have someone who's maybe buying like a home for $1 million, especially in this area, which is pretty common.
Yeah.
And when I come back to them and I tell them, you're paying $1 million for your house, we're only going to insure it for $750,000. Some people are scratching their head. Yeah, some people are scratching their head and they're like, hold on, Craig. You know I'm buying $1 million house, right?
Right.
I'm like, yeah, I know. And they're like, so why don't I have $1 million worth of coverage? And I'm telling them, I got to educate them. And I'm telling them it's not equivalent, because the purchase price of your home and your appraisal is not equivalent to what it's going to cost the insurance company to rebuild your house if it's destroyed down to the ground as a result of a fire. Because if your home burns down to the ground, we're only building structure itself. We're not touching the land.
So
in this area,
right.
Yeah. So you get it. Yeah, you get it.
So if you're buying a house for $1 million, as I understand, that's both land and improved structure. Generally, land is 15% of whatever the price is. But in this particular situation, land is a lot more than the improved structure. So
especially
if
in the
it's
District of Columbia.
Especially
in the District of Columbia, especially in DC.
So if it's a $1 million home, the land is 250,000. The structure is 750,000. That's the reason why you're not getting the $1 million coverage. So after you've gone through the coverages with them, to get this policy off the ground, what else are you working with them on?
It's a great question. I'm actually glad you asked me that, because once I go through that and they're like, okay, I'm loving it when people are like, okay, Craig, I love to hear no one's ever explained it to me like that.
Got it.
That lets me know I'm doing my job. I love to hear that. I love it. Because now I'm like, all right, they may have already spoken to 2 or 3 other people, and that person just went, okay, this is this, this is this, this is this, this is this. It's $800. They didn't do the same thing. And now I'm like, okay, let me bring this home. So now I've gone through the policy, and now I'm saying, okay, if you like this, we can wrap this up and we can get this going. However, this is what I'm going to do.
Yeah.
What I'm going to do. If you take this policy and you close on December 1st, I'm calling you and I say, okay, when are you planning on moving? Well, I'm going to move in on the weekend on the 3rd. Okay. You're closing on the 1st, you're moving in on the 3rd. I'm going to call you 2 weeks after you move in.
Why?
And I'm going to call you because you're doing everything you can to buy this house. I got to make sure you do everything you can to keep this house.
What do you mean by that?
So now what I'm going to do is whatever is most important to you. I don't know. You have to answer that question. I'm going to do everything in my power to offer you the ability to keep your home, so you do not lose your home in the event of a loss from either a disability or from a death. And this happens. It happened to me. My brother went to work one day, he didn't come home. He was 48. I'm 46. This was 3 years ago.
Wow.
So I'm speaking from experience. So let me do whatever I can to help you and your family so you aren't impacted by this. So 2 weeks after you move into your house, I'm going to call you and I'm going to ask you if you allow me to run 2 quotes for you. A mortgage protection policy, which is a life insurance policy, to cover your mortgage in the event that you don't come home one day, like my relative, or in the event you get disabled and you can't work, and you have an illness, an injury, or a sickness, and you can't work. We will have a policy and put it in place where if you can't go to work, after 30 days, State Farm is sending you a check to cover that mortgage payment.
So then let me go back to the covering your mortgage if there happens to be a death, because for most families that are out there now, it's a 2-income household, right? So if someone in that household were to pass away, heaven forbid, that represents a hardship where the family's going to have to come back to me and to you, more than likely me, if they don't purchase this other policy and say, we may need to move because we aren't able to, pay the mortgage on this. And so this other life insurance policy that you're talking about, is this a whole life, or is this a term, or is this just specific for the value of the home or the replacement value of the home? What help me understand how much you're doing this for?
Good question. Typically, I start with, what did you take a loan out for? Typically, most times, okay, in this area, you could probably confirm this. Okay, our mortgage, our loan amount's gonna be for $300,000. I use that amount. Say, okay, you're paying 300. I know you were used to it. So we'll say, okay, 300,000. All right, you got 20, 30-year loan. You're 35 years old. I'll run the numbers. Jonathan, it's not even $50 a month. It's like $35.
No, but in terms of, so it's $35 a month, but then in terms of the value of the policy upon that person's untimely passing, it would be for that full $300,000 to pay.
Yes, sir.
Yes. Got it.
That's where we're starting. But there's a little bit more intake on that. So I'm fact finding. Oh yeah, I'm fact finding now. I'm fact finding. So I'm finding out how many kids they have, if they gotta send kids to college.
Well, say I already have a policy. Say I already have a policy for my job.
That's better. That's even better. That's even better
Okay.
because I'm not trying to replace anything.
Okay.
I've been on this 12 years, man. I never go into a home and say, get rid of that. You don't need that. Unfortunately, there are some professionals that do that. I'm not one of them. I never tell them to get rid of anything. You got 5, keep it. Great. Glad you got it. You've been doing the right thing. This is not what I'm talking about here. Now, if you want additional coverage on top of that, we can meet that need too. But this is solely to protect your investment, because in the event, and I use the word, I got it from my mentor. I hope I'm applying it right. I'm using the term, you're putting in all this sweat equity. So you mean to actually tell me, Mr. and Miss Smith, you're going to get up and go to work every day. You're going to blow all this blood, sweat, and tears for the next 20, 30 years.
Mm-hmm.
You're going to give this mortgage company all your money. And you mean to tell me if something happens to you or you don't come home, you got this spouse or you're by yourself and you got these kids and your investment is just going to go down the drain.
But if I bought the 300,000, that takes care of the house, but you're asking about kids and other things for what purpose? Help me understand that.
Well, now I have to fact find if you have any other outstanding liabilities that you would like to cover. I don't know that. That's why I have to ask.
So you're talking about like if I have another car, if
Correct.
I have other investment property, if I
Correct.
have any other debt that's out there.
Correct.
Because you're saying that you could then write a policy that could potentially cover all of that external or extemporaneous debt that's out there, right?
Correct. That is correct.
Got it. Okay.
Yes, sir.
Go ahead.
Yes, sir.
Keep going. I'm sorry, I didn't mean to cut you off. I just wanted to make sure I was understanding. So if you're doing the fact finding to know what the entire budget would be. Now, are you adding anything else more on top of that for, say, income or, spending change, as it were? Because I'm thinking, like, I've heard, someone say, whatever you're making, a year, you need 10 times that. I've heard that as a rule of thumb in terms of insurance. And maybe I'm incorrect in saying this. And so I'm listening to you. Answer those. I know it's 2 questions I asked you.
No, you're fine. No, you're
10
fine.
times your income, or is it all of these other liabilities, and then there's some spending change, and there's some other whatever you guys do?
You can't write down my street on that. Actually, okay. you really did. It's a little bit of both, actually, because you want to know, like, Jonathan, I can't walk into somebody's home and tell them what they gotta have. You know what I mean? I can't.
No, I understand.
So I need to find out from them what they want. So they may want to send their kids to college and have money for their spouse. You know what I mean? To have if they're not there. So for me to sit up there and talk about, I don't know, I try to make something up.
That makes sense. That makes sense. Yeah. So money for college, et cetera. So does this get put into a wheel of sorts? Where somebody has to say, there's this life insurance policy that I got after we moved into this house. It'll pay for the house. It'll pay for the car. It'll pay, put $50,000, aside, or $100,000 aside for each of the children, for college. I mean, how do I put that in the life insurance policy? How do I designate that then?
It's solely up to the individual. So what I'm doing is, because you asked me like 2 or 3 questions ago, you said, Craig, is it is it term, or is it permanent, or is it whole life? I'm addressing it right then and there, because I'm giving them more than one option. I never like to just give one option. I never like to do that, because when you give people one option, they feel as though they're getting pigeonholed. I don't like to do that. I like to give people choices. So I'm going to present that $300,000 30-year policy, but Jonathan, I don't know their budget. I don't know. They may have some money, and you'd be surprised, man. People who you least expect will have money and be like, man, this guy may have, $50,000 buried in his backyard before. I've heard stories like that before. So we'll present that one, and then I'll say, well, okay, well, guess what? You can have this permanent policy that's $300,000 that over the next 30 years is going to build up $150,000 into it that belongs to you while you're living, and the family will get the money when they pass away. But the living benefit of 150 grand will be yours, but it's not going to be the 30 to 50 bucks a month. It might be $300 a month.
Got it.
It's a little pricey, but it's a different perspective.
Yeah,
You know
do
what I
you
mean?
need to have cash flow now while you're living is the key. Do you not
Correct.
need to have some sort of an
Yes.
annuity of
Yes.
sorts?
Yes,
Mhm.
yes. And I use myself as an example because I'm
Mhm.
prime example. And I have both policies. I got both. I got both.
What do
I
you mean
got the
both
one.
policies? You
I
have
have one. Yes. I have one to cover. I got one for I got one for 250 grand, which is term. Another term for about 100 for 50 grand, and they're both term. They'll cover our mortgage, and I have a permanent policy for 150,000 that I'm just socking money away into that.
Okay.
That's my money.
You said when you're socking money, you're talking about from vis-a-vis the premium and
Yes,
how
from the
the
premium.
insurance company is managing
Correct.
that by investing.
Yes.
Okay.
Correct.
Okay.
That's why I said it's my money. So when I pass away, my family gets the death benefit. But over time, while I'm still breathing, I'm living, that money is starting to accumulate. And the next 5 years, if I want to pull out 10 grand or 5 grand and it's there, it's mine. I do with it as I choose.
So then there is money there for that, for purchasing whatever. But then you also mentioned looking into the potential of disability, which does
Yes.
happen as well. You know,
Yes.
sometimes, things happen. And so what do you mean by that? What have you seen? How do you approach that?
Well, initially, that question, I talk about both of them at the same time. I talk
Right.
about the mortgage protection and the disability at the same time, but I put it on the table as in, what is more important to you? Is one more important than the other, or are they both important? So I put it back to the customer, and they'll tell me. They'll go, well, Craig, I'm not really necessarily thinking about, because I just had this one guy. I actually thought he would get the policy to cover his mortgage. He wasn't interested. But listen though, I know why though, Jonathan. He was a plumber by skilled trade. So he was, you know what I mean? So he worked with his hands a lot. And he
So
was like,
he was interested in disability though.
just on his disability. He wasn't concerned about paying it off. He was like, man, I could potentially get hurt. Yeah, you know what? I need that. Sign that up.
So what is that? Is that disability from working at all or working in the particular field that you're in?
Anything. That could be you being in
because I
anything.
know that there are certain insurances that are specifically, short-term, long-term disability, specifically tied to maybe say a cognitive disability or something, because you work, it's tied to your work. So, but you still can go say work at fast food,
Yeah. Let me tie that in too, because especially us being in this area that we're in,
Certainly.
And us being around a lot of government workers,
Certainly.
When we mention that disability product, the majority of responses I get as a result of that is, will it help me if I get laid off? That's the only thing that it doesn't cover. Okay. Because think about it, you're not disabled. You know what I mean?
No, I understand.
They're like, Craig, that sounds great, but like, so if I get laid off, and I'm like, well, that's what unemployment insurance is for.
Yeah.
No, you can't get that. We're talking about if you're in a car accident, if you're hurt from work, if you get
carpal tunnel syndrome,
you get surgery on your shoulder,
right?
You get cancer, right? You get cancer. My wife, Jonathan, my wife came home. I came home on Friday. My wife's not even 40 yet, man. I came home on Friday. My wife told me, in February, I'm getting surgery. I'm going out. I looked at her like, for what? She was like, on my foot, on my toe. I ain't embarrass her, but she was like, I was like, how long you going out of work? She was like,
it's too late. You'd already embarrassed. I apologize for him, ma'am. I apologize.
She was like 2 months. She was like 2 months. I was like, you going out of work for 2 months? Jonathan, we got a policy. I'm paying for it.
Okay. So that's going to protect you, replace her income while she's out for those 2 months.
We got a policy. I pay for it. I think it's about $2,000 a month. I mean, it's not a ton of money, but something.
But in terms of premium, how much? It's a benefit to you of $2,000 a month. But how much is the premium?
Tell you right now. I'll tell you.
Well, I mean, I don't know if that's too personal. I apologize if I'm.
Nah, come on, man.
Again, this is going out to a bunch of people. This is in the public, so I mean, I don't want to.
Man. Come on, man. That's not that important to
I
me. I'm an open book, man. I'm an open book. I tell you right now, I am paying for her. Here it is right here. I got one for me, my wife, and my son. Hers is right here. Hers is. I figure my son, once I get him playing some sports, and he gets into that youth soccer league, and I got to take him for maybe get some stitches or something like that. I figured I collect on that too. Hers is like $32 a month.
Okay, so that not bad. So this is additional disability insurance just in case that you are there. I want to go back because again we're talking primarily to investors and commercial realtors, and we aren't plumbers, right? We aren't construction workers where we could get hurt or anything like that. But there may be a situation where we get disabled, or there may be an untimely death. When you're going back, say, to that untimely death policy, right? That additional life insurance, are you taking into account the investment properties that they have as well? Because some people have portfolios that are currently have a mortgage on them that, again, if something were to happen to them, now their family is in another bind. They are in another financial bind where they have to figure out, okay, dad or mom had this, investment portfolio. We don't know how to run it. And now we're going to have to go through and wholesale it, versus, maybe keeping it and learning how to deal with it. Is that something that's also a part of your presentation, or is that something that could be included in that?
It could be. And I'd like to tie this in. It's not the same term, but you brought it up. Okay. And I want to mention, but because you brought it up, and I want to mention it.
Sure.
And I want to tie them in. You said, Craig, like they got all these properties, and they got to manage them, and now the person who was running it is gone. But now who's going to do it? Our I hate to say just our commercial, because this is what we're talking about, people who own a lot of properties, especially if they're commercial property, but it still ties in. Our commercial property owners who own like a huge office building, they rent it out. We always tell them, if you have a key employee and you lose your key employee, and let's say they run the whole ship, if they leave, who's going to replace that person? So what we call that is we call that, it's two terms. You either call it key employee or key man insurance. You get a policy on the individual who's the key person. So if they do leave, you have money to go out and hire someone else. It applies to your concept.
Okay, so then there's a couple things here. So if we have a key person, right, that leaves the organization, this insurance provides resources to be able to go out and hire somebody else potentially to do, say, property management for the portfolio. But let's just say that this key person passes away and is, because a lot of investments are mom and pop type of investments, right? You own a couple of houses, say, in Sea Pleasant or in Capitol Heights. We're talking about areas in the Washington, D.C. area, right? And you've been renting those out, and you've got maybe 4 or 5 of them, right? And someone in the family passes away. Is that also considered key man insurance to pay off the mortgages for those particular properties?
Yes,
to pay off the mortgages, in addition to potentially hiring somebody to come and manage those.
That's why I said that's why I said you tied it in and you didn't even realize it, because I wanted to use that key man as the example, but I want to still apply it to our topic that we're talking about today, and use using the key man as an example and use that as me. So let's use me. I bought this house. I plan on next year buying my first investment property. My goal, I can't believe that's all right, I put it out there. My goal is to own maybe 50 to 100 units by the time my last breath, hopefully within the next 40 years. That's my goal.
Well, then, you need to come on over here to the commercial space. We'll talk about this.
Yeah, that's my goal. I'm being honest. Now, I do, let's say even 100. Let's say it's 30, right? If I got 30 properties, I'm running those. Okay. I got a 25-year-old daughter and I got a 2-year-old son. My daughter is going into the nursing field. My son, who knows? But still, something happens. Who's going to run? My wife is a supervisor at Walmart.
Got it.
I need someone to run that. Now I'm leaving it behind to them. Of course,
yeah, you're leaving it, but you're also leaving that debt. So the key man policy is going to take care of both the debt.
Bingo. And that you just set me up. That's where I was going to.
I'm sorry, I'm
just more long-winded than you. That's all. I told you I talk a lot. I've been talking all day. I'm just more long-winded than you, man.
It's all good, man. It's all good.
Yeah. But yes. So those 30 properties, I got, throw a number out there, Jonathan. You just field. I got
you have about $3 million. Let's say $3 million.
Yeah, I got $3 million in debt, right? I'm gone. Why? Do you think I want my son and my wife to sell them 30 properties? I didn't buy it for them to sell them. I bought it for them to keep it so we can have generational wealth because I want my great grandson to have it.
Right.
I didn't buy them for me. I bought them for them. So now that I'm gone, I don't want them to sell them. No. So I'm going to have a policy in place. So when I'm gone, they can pay all that stuff off, whether it be my properties, whether it be a huge tax bill, no matter what it is, estate transfers. I think they got away with that. Somebody just told me that last week. But all of that stuff, that's what you can use life insurance for. People always thinking, oh man, I got money. I don't need that. No, if you want to leave something behind, that's great. But that's not what it can all be used for. You can use it for numerous things.
Right. So the cash that you have can be used for day-to-day kinds of things, et cetera, et cetera, et cetera, while the insurance policy kicks in place and, you can direct in your will, in your estate, et cetera, that key man policy pay off all of those investment debts. You have your own life insurance policy that's going to cover your own personal debts. So essentially your spouse, your family is debt-free should something happen to you, and potentially have additional resources to be able to hire people to take care of the investments, as well as have additional resources to make sure that your family is continuing to move forward with you no longer there bringing in additional resources. So I think, and that was what I was really, really impressed by, in that you call them 2 weeks later. Now, I know most people are probably not going to be thinking about that if they're going to be moving into a house. And at the time that we're recording this, we're at the end of 2020, which has been a very interesting year. We've had, close to 260,000 people who've passed away, and just a bunch of different things. And, it just brings to mind, wanting to have peace of mind. And I think that that's what you can definitely bring to the table. And we not necessarily differentiate solely on price, but on what's there. I'm sorry. Go ahead, sir. You got something else?
I like the word. You've been driving down my street all day. You use the word. You use the word peace of mind. Yeah. That's actually a term and a phrase that I came up with, that I use in my classes when I'm going through the coverages, and I talk about having a peace of mind, having certain coverages. Making sure that you have it, making sure you're properly covered, and going through this stuff, giving you a peace of mind. Right. Because you know what I mean. That's pretty much, if you don't, you know what I mean. It's that unknown. You know what I mean. You're always worried. Right. Yeah, you're always worried. And the other thing I wanted to bring up is some industry professionals. Believe it or not, we get in. This is no knock on you. I'm talking about realtors. No knock on you guys, but I typically find, and the industry professionals shock me, is that, and I think this is down your street, that's why I'm bringing it up. We find a lot of people who own a lot of condo units, they don't think they need insurance because of the condo. Yeah, you'd be shocked. Because of the condo associations and the master policies.
Right. Generally, condo associations have a master policy, but they require each individual owner to also have a policy with the rider, where if I'm not mistaken, the condo association is kind of partial beneficiary. So if something happens to your particular unit, you need to have homeowners insurance, if you will, for the condo, right?
Yeah, but think of some of your cohorts though. Think of some of your peers. They're thinking, well, I got a condo, I got a master policy, and I got a tenant in there, and I can make my tenant get a man. You be Jonathan.
Well, here's the thing. If
I didn't say you. See, you.
I understand.
We're not talking about you.
If you're renting out a condo, you need to check with your condo association. Man. Yes, they have a master policy. Because I'm thinking of one particular condo association right now. I will not call the name.
Mm-hmm.
That no longer is getting FHA funding because of some similar things that you're talking about, where a good portion of their ownership are people who are investors, and they get tenants in there who don't get renters insurance. So my end game here is the condo association has a master policy. You as the owner need to have a policy, and you need to require your tenant. You should require your tenant to have a policy. All three.
All three. But John, John, I like you're a professional. Man, I have realtors.
Look, this particular association, I'm not gonna get specific. All I will say is that a lot of owners purchased and had tenants that were doing things that were not scrupulous, and it really caused that association to really be in a bad way to go. So yes, you need to have your own policy, and you need to have your tenant have a policy and make you the beneficiary.
All three. I think some people, like I said, we're not talking about you, but I just think that some people, they get that whole mindset of, all right, at the condo association, I got a tenant in there, and they're going to have a policy. I'm covered from that call. You know what I mean? No, the policy is between $100 to $300 a year.
Oh.
You know what I mean? It's not, it don't even cost that much.
That's a peace of mind, people. That's a peace of mind.
Peace of mind.
Don't cut those corners if it being so low, because the cost on the other side if something happens is so much higher. And, given that we're in a litigious society, specifically in the Washington, D.C. area, I believe they said that Washington, D.C., especially around K Street, per capita has more lawyers than any other place in the United States.
Oh, yeah, K Street. Oh yeah, K Street. They roll heavy over there, man.
So you need to have all of that. Well, listen, we've been talking for a while, and I know we can keep going on forever.
I told you got me going.
How do people get in contact with you, though, Craig? How do people get in contact if they want to talk to you about what's happening, in their own specific situation, especially if they're investors, right, that are out there? I mean, key person insurance, I think, is already for a lot of the larger commercial people. They understand it, they know it. But for somebody, say, who is smaller, who's growing, who has a couple of rental houses and things of that sort, how do they call you and start that conversation? What should they bring to the table when they're doing that?
I would first off, the office number is 240-828-8862. Once again, 240-828-8862.
Are you on any socials or do you have a website?
Yeah, I'm on Facebook. Instagram, just personal, but I am on Facebook.
What's the name of Facebook?
Facebook, Craig Adams State Farm. Craig A. Adams, because there's like 10 Craig Adamses on Google, and one of them is like a famous hockey player. So I had to make sure I'm distinct though. I got my middle initial, so it's Craig A. Adams. You put Craig A. Adams, you find me.
That's on Facebook, and then on LinkedIn. How do they
LinkedIn? Same thing, Craig Adams on LinkedIn. Craig Adams State Farm. So I have my own sites on LinkedIn and Facebook, social media. My bus sign is about to come down at the end of this month.
Your website. Do you have a website?
Oh yeah, we do. Sorry about that. Good point. My website is www.insurancecollegepark.net.
Okay. Insurancecollegepark.net.
Insurancecollegepark.net. I gave the number. What other question did you ask me? Is that it?
What do they need to come to you with? They need to go and gather some things to have a conversation with you.
Great question. I would say all of their um, business information regarding property locations. They want to bring personal information as opposed to if they have like another job, like their employer. I would bring some of their liabilities as far as they don't necessarily
And when you
have
say
to
liabilities, break that down for some people. We're
That's
talking
what I was
about
going to say. That's what I'm saying. They don't
cars.
necessarily have to. Yeah, they don't necessarily have to bring like receipts. But if you know you got a $300,000 mortgage and you know you got your cars to pay off and your kids are in college, at least have an itemized list and know your numbers. You know what I mean? That's why I said you don't have to physically bring in those documents,
Got it.
but you want to at least, especially these people that you're talking about,
Got it.
because we don't only want to fact find. We're looking for holes. The way I was trained and what we're trained to look for, and you asked me, you said, well, Craig, a couple questions back, you said, Craig, some people already have insurance. My job isn't to duplicate what you have. If they come to me, Jonathan, and I see that they're bulletproof and they're covered, they're covered. Oh man, he's trying to sell me something. If you got it covered, there's nothing to sell you.
Right.
There's nothing to give you.
Right.
But if I find a hole, if I find a gap,
right.
I'm telling you, this is covered here. Here's your gap.
Right.
You asked me, Jonathan. You said, what else can they cover, Craig? Someone's income. Yes, Jonathan. You'd be surprised. The average person that may make $40,000 or $50,000 a year, they don't think they're a millionaire. They're a millionaire because if they multiply that times 20, they're going to make $1 million in their lifetime.
Got it.
You're a millionaire. Yes, you are.
Got
you
it.
are a millionaire. I don't have that much money. Yes, you are. Because in the next 10, 15, 20 years, you're going to amass that amount of money. So guess what? I got to show you something along those lines. But people don't hear that.
Got it.
So they don't think that applies to them.
So they need to bring their if they have property, bring their property.
Yes.
If they have coverages already, bring some of those documents.
Correct.
If they have liabilities, meaning what is your current house? If you own a house, what's the outstanding balance on that? If you have cars,
Correct.
You have student loans, if you have
Correct.
students that are in college and still have time, or you want your kids to go to college, if something were to happen in your untimely demise, and also think about, disability insurance, and you're going to walk them through that process.
Correct.
Well, listen, Craig, I thank you for coming and giving us a conversation worth having, again, for helping to do some asset protection. Assets, the things that you have, you can protect those things and, again, have peace of mind. And it's not necessarily just a marketing ploy, but really something to think about once you start amassing, investments and investment properties in our context here. Is there anything else that you'd like to say to those that are listening that we didn't cover here?
Not really. I just think that you really hit it home, and I think a lot of your questions, you I don't want to say you led me in that direction, but like I said, you came right down my avenue. You use a lot of buzzwords that I like. You just use the word asset protection. Mm-hmm. Asset protection may not apply to that single homeowner that I'm assisting in an HPAP program, but the people that you work with that may have 5 rental properties or may have 50 of them, asset protection applies to them.
Yeah.
You know what I mean? And
I still think it works for those that are in HPAP.
It does. It does. I just think it resonates more.
Yes, that buzzword resonates more with my community. But just for anybody else who's listening, if you're in the HPAP program, whatever, your home is definitely your asset.
Oh yeah.
Especially if you go ahead.
No. I was just saying, like you said, those people, they get it, man. They get it. They're like, man, I got, like you said, somebody got 15, 20 properties and, tons of other liabilities. They know they got to get that stuff. Most of them know that they got to get that stuff covered.
Understood.
But I just want to come back. That's all. I like this. I like it. I like educating people. I just want to.
All right.
Back.
Well, we'll find some sort of space in here where we can have a further dialogue. But again, thank you for coming, and check us out next time for another podcast. Thanks again, Craig.
I appreciate you, man.
Peace.